Question 281. Which of these types of deeds includes a granting clause, but no warranties? A. Grant deed. B. Quitclaim deed. C. Deed in lieu of foreclosure. D. Trustee's deed. Correct answer is B. Quitclaim deed. A grant deed not only contains a granting clause, conveying interest in real property, but also provides implied warranties from the grantor. These warranties assure the grantee that the grantor has not already conveyed the property to another party and that there are no undisclosed encumbrances that would affect the title. A deed in lieu of foreclosure is a specific conveyance where a borrower voluntarily transfers property to the lender, thereby preventing foreclosure proceedings. While it shares similarities with a quitclaim deed, it is not defined solely by the absence of warranties, and typically includes a limited warranty from the borrower. In a foreclosure sale, the trustee issues a trustee's deed to the winning bidder, conveying legal title. This deed provides limited warranties, primarily focusing on the trustee's compliance with the procedural requirements of the foreclosure, rather than guaranteeing the quality of the property's title itself. A quitclaim deed, containing a granting clause, transfers any and all interest the grantor may have in the property, but provides no warranties or guarantees regarding the title's condition. This means the grantor avoids any liability for potential title defects. The grantor simply quits any claim they may have to the property. Question 282. A listing is what kind of agency? A. Executive agency. B. General agency. C. Special agency. D. Dual agency. Correct answer is C. Special agency. Executive agency is not typically used in real estate agency law. A general agency grants the agent broader authority to act on behalf of the principal in a continuing business relationship. Dual agency occurs when a broker represents both the buyer and the seller in the same transaction. While a broker could become a dual agent, the listing itself creates a special agency. A listing agreement creates a special agency relationship where the broker is authorized to find a ready, willing, and able buyer for the seller's property. A special agency is created when a principal, the seller, authorizes an agent, the broker, to perform a specific act or series of acts. Specific tasks, such as a listing, a contract between a property owner and an agent authorized to obtain a buyer, are performed under a special agency. The broker's authority is limited to this specific task. Question 283. Which of the following would make it impossible for a claimant to acquire real property using the method of adverse possession? A. The claimant mistakenly believed the property where he resides was his, due to an unclear property description in his title. B. The claimant paid all property taxes on the property while he resided there. C. The claimant resided on the property for 6 years before the actual owner attempted to have him evicted from the property. D. The property in question is part of federally owned parkland. Correct answer is D. The property in question is part of federally owned parkland. A claim of adverse possession can still be valid even if it is based on a mistake. Hostile, in adverse possession, does not mean there is ill will, it just means that the occupation is done without the owner's permission. Paying property taxes is often a strong indicator of adverse possession and strengthens a claimant's case. While the required period for adverse possession varies by state, 6 years could be sufficient in some jurisdictions. Adverse possession generally cannot be used to acquire ownership of government-owned land, particularly federal land. This is based on the doctrine of nullum tempus occurret regi. Time does not run against the king, which essentially means that the government is immune from claims of adverse possession. Federally owned parkland is government property, and therefore, it is not subject to adverse possession. Question 284. The second installment of real property taxes becomes due on A. February 1st, B. June 1st, C. December 31st, D. January 1st. Correct answer is A. February 1st. The first installment is due on November 1st, delinquent December 10th. The second installment is due on February 1st and is delinquent if the payment is not received by 5 p.m. or postmarked by April 10th. Question 285. When a real estate broker sells a land contract, he must arrange for the contract to be properly assigned and recorded in the county where the real property is located within how long after escrow is closed? A. 5 days, B. 10 days, C. 1 month, D. It is not the broker's responsibility to have the land contract recorded. Correct answer is B. 10 days. A land contract is an agreement between a seller and buyer in which the buyer obtains financing from the seller to purchase the property for an agreed-upon price and then repays the loan in installments. In California, when a real estate broker facilitates the sale of a land contract and receives a commission, they are required to ensure the agreement is recorded within 10 days of the close of escrow. This requirement is designed to protect the buyer's interest and provide public notice of the land contract. Question 286. The instrument used to secure a loan on personal property is A. Collateral agreement, B. Pledge agreement, C. Trust deed, D. Security agreement. Correct answer is D. Security agreement. The security agreement is a document providing a lender with a security interest in a specified asset or property that is pledged as collateral. If the borrower defaults, the pledged collateral can be seized and sold. While a collateral agreement can be part of a loan agreement, it doesn't necessarily create a security interest. It might simply specify the collateral that will be used to secure the loan. A pledge agreement is typically used for creating a pledge, which involves transferring possession of personal property to the creditor until the loan is repaid. Trust deeds are primarily used for real estate loans, where the title is held by a trustee in case of default. They are not typically used for securing loans on personal property. Question 287. Generally, the biggest industrial finance loans are funded by A. Savings and loans, B. Commercial banks, C. Insurance companies, D. Fannie Mae. Correct answer is C. Insurance companies. Savings and loans, S&Ls, traditionally focus on residential mortgages and consumer loans. Commercial banks can be involved in industrial lending, but insurance companies often have a larger capacity for these large loans due to the nature of their business model. Fannie Mae is a government-sponsored enterprise, GSE, that deals primarily with residential mortgages. Insurance companies have large pools of capital from premiums paid by policyholders. While commercial banks handle a wide range of business loans, life insurance companies specialize in substantial, long-term commercial mortgages. Therefore, it is accurate to say that larger life insurance companies are very active in funding large commercial mortgage loans. They often seek investment opportunities for this capital, and big industrial loans can be an attractive option for them. These loans offer potentially high returns, but also come with higher risk compared to many other investment options. Insurance companies can manage this risk by carefully assessing the borrower's creditworthiness and structuring the loan terms appropriately. Question 288. They work directly with borrowers, set up real property appraisals, underwrite and service loans. They are A. Fannie Mae, B. Primary mortgage lenders, C. Investors in government securities, D. Secondary mortgage lenders. Correct answer is B. Primary mortgage lenders. Fannie Mae is a government-sponsored enterprise, GSE, that buys mortgages from lenders and packages them into mortgage-backed securities. Investors in government securities are entities that invest in government bonds and other debt instruments issued by governments. Secondary mortgage lenders buy existing mortgages from primary lenders. Fannie Mae, investors in government securities. Secondary mortgage lenders don't typically work directly with borrowers, set up appraisals, or service loans. Primary mortgage lenders are the financial institutions that originate mortgages. They handle the entire process from initial contact with the borrower, application processing, underwriting, evaluating the loan risk, loan approval, and often servicing the loan, collecting monthly payments. They work directly with borrowers and ensure all the steps are completed for the loan to be funded. Question 289. The front-end ratio for a loan is determined by A. The amount of mortgage interest owed during the first 6 months of the loan. B. Calculating the percentage of monthly income necessary to meet monthly housing expenses. C. Calculating the percentage of monthly income necessary to meet monthly housing expenses minus any short-term debts. D. The introductory loan interest rate. Correct answer is B. Calculating the percentage of monthly income necessary to meet monthly housing expenses. The amount of mortgage interest owed during the first 6 months of the loan is a part of the calculation, but not the entire ratio. Calculating the percentage of monthly income necessary to meet monthly housing expenses minus any short-term debts is more like the debt-to-income ratio, DTI, which considers all debts, not just housing expenses. The introductory loan interest rate is a component of the monthly housing expenses, just influence the initial payment amount. The front-end ratio is also known as the housing ratio. It is calculated by dividing the total monthly housing expenses, principal, interest, taxes, insurance, and WA fees, if applicable, by the borrower's gross monthly income. It is calculated by dividing the total monthly housing expenses, principal, interest, taxes, insurance, and WA fees, if applicable, by the borrower's gross monthly income. It's expressed as a percentage of the borrower's gross monthly income. Question 290. To find the value of Greenacre, an appraiser looks at a comparable home in the same neighborhood that sold for $250,000 a year ago. During that year, property values for that neighborhood rose 8%. So, Greenacre is now worth A. $290,000, B. $300,000, C. $270,000, D. $350,000. Correct answer is C. $270,000. $250,000 by 8%, expressed as 0.08, equals $20,000. $250,000 plus $20,000 equals $270,000. In law, a greenacre is a fictitious estate in land used to discuss the rights of different parties to a piece of real property. Law professors in common law jurisdictions often use greenacres as placeholder names.